fresh off the presses, famed bond investor Bill Gross's monthly investment outlook, where he says the reality of today is that, and I quote because this is perhaps my favorite line in the whole report, not even thin gruel is being offered to our modern day Oliver Twist investors. You have to pay to come to the dinner table and then sit there staring at an empty plate. In other words, you're paying Germany, for example, to hold your money right now. Well, what does this mean for the health of the investing world? What does it mean for the Fed? What does it mean for pension plans? What does it mean for you? Janus Capital's Bill Gross joins me right now. Bill, welcome back. It's great to have you back on the show.
Thank you, Trish.
I can say, anytime you can work Dickens into an investment letter, along with a few references to the Westminster Dog Show, my hat goes off to you.
Thank you. Here's another one. Back in the Depression in the 1930s, humorist Will Rogers said that he wasn't so much concerned about the return on his money, but the return of his money. And in today's financial markets, where, as you mentioned, $2 trillion of Euroland paper trades at negative yields, some as much as minus 75 basis points, I think Will Rogers would have to be concerned about both. A negative yield assures the investor that not only is the return on his money or her money unsatisfactory, but the return of her money will be less than he paid.
You know, it's pretty crazy. And you've got investors, Bill, out there that are getting somewhat desperate, right, for yield because, as you rightly point out, there's just none out there. So theoretically, let me ask you, could that change? Should it change? Do we anticipate that Yellen will raise rates in June?
Well, I think that's part of the problem, although it's one that can't be easily diagnosed in terms of historical models. To the extent that interest rates at the zero bound in the United States, promote higher stock prices, higher bond prices. Some of that trickles down to the real economy and, promotes growth. But to be fair, not much has. What has been promoted has been, potential bubbles in stock markets and in bond markets. And I think the Fed is willing at this point to at least acknowledge that by raising interest rates 25 basis points in June. I also think, and this is important, Trish, that the interest rate can't be raised substantially even over the next 2 to 3 years. I mean, the market is anticipating a 2% Fed funds rate in 2018, late 2018. And I think the reason that they can't is that the U.S. economy and the global economy, to which the U.S. dollar and the U.S. interest rate basically serves, is too levered, too highly levered. There's too much debt, and ultimately 2% is probably the top in terms of this Fed cycle.
Let me ask you, though, how, Bill, does Yellen and company get off of the zero interest rate policy at a time when the U.S. dollar is showing so much strength? You talk about, the currency war effectively that we're seeing right now, though nobody wants to call it that. But how can the Fed move when the dollar has already rallied as much as it has against other currencies?
Well, I think that's a really good point, and I agree with it. Obviously, I put that in my investment outlook. A stronger dollar does promote, some negatives. It promotes not only lower exports and lower growth in terms of manufacturing, but it promotes an infusion of deflation as opposed to inflation, which is exactly opposite to what the Fed wants to do. Today's number, Trish, the personal consumption index, on a year-on-year basis was 1.1% and going lower, and their target is 2%. So ultimately, that's, again, one of the reasons why, if they get off the dime in June or if they get off the dime in September, that they basically have to go very slowly, because ultimately a stronger dollar promotes lower growth in the United States as opposed to higher growth.
You mentioned this lack of inflation, 1.1% versus what they'd like to see, 2%. Do we need to be worried about deflation? Clearly, it's a concern overseas. Is that a reality that we could be facing?
Well, I don't think so in the United States. I mean, for the most part, our inflation indexes outside of oil and outside of food prices, basically reflect health care expenses and wages in the United States, which are going up by 2% themselves. So the United States, it appears, has escaped this, this trap, this liquidity trap that Euroland and Japan are in, but not necessarily for all time. And so, do I have to be worried about it now? No, but I think if the Fed truly wants to get to a 2% inflation rate, which, by the way, is the reason why they need to get there, is that in an ensuing recession or slowdown, they need some room to lower rates. And so, if the Fed eventually gets to 2% inflation, then that's probably the sweet spot for Janet Yellen. And
you
the
say
Fed.
Eventually 2%. I mean, how long is it going to take for that to unfold? Do you think these are going to be very slow moves, Bill?
I do. I basically think, 50 basis points a year. Right now, the forward market, as I mentioned, is anticipating a 2% Fed funds rate in late 2018, so that's 3.5 years. Whether or not that's the proper path, the proper the slope in terms of a forward yield curve, no one really knows. But it gets back to what I talked about in April of last year, the new neutral rate, the new policy rate, which ultimately, in my view, has to be much lower than historically because of high leverage and because of demographic influences that basically promote lower structural growth.
Bill, Janet Yellen has indicated that she's going to stay patient, but here we are, 6 years into ZIRP. We've had multiple rounds of QE, and all we've got is this anemic growth. In your view, has the Fed been too patient? I mean, do you worry at all that its policies have actually had the unintended consequence of causing people and companies to delay purchases because they know money's going to be cheap for the foreseeable future?
Yeah, I think they went too far, Trish, and that's a subjective assessment of history, I guess. But a 0% interest rate, induces positives in terms of higher bond prices and stock prices, but also some negatives. It keeps zombie corporations alive because they can borrow at 3 and 4% as opposed to 8 or 9%. It destroys business models. It's destroying the pension industry and the insurance industry because basically their liabilities can't be provided for by very low interest rates. And ultimately, I think it destroys the capitalistic model at the margin. You talk about stocks and cheap money. Basically corporations, instead of investing in the real economy, can now simply borrow at close to 0% and buy their own stocks, which yield 2 or 3% on a dividend basis, and provide a return of 6 or 7% on a earnings to price ratio basis. So there are a lot of negatives in terms of zero-bound interest rates, and I think one of the reasons why the Fed will move is to sort of gradually move away from those negatives.
Yeah, it's given birth to all this financial engineering, but you wonder these days whether investors are really valuing assets for what they're worth. Let me ask you, with that in mind, do you ever worry that the Fed is just perhaps too forthcoming in its information as well? I mean, they seem to want to tell us everything and anything that they're going to do, and I just wonder whether investors have become overly reliant on that telegraphing from the Fed. I mean, do you ever long for the days when you actually had to wait and check the markets to see what the Fed had done back before it was as transparent as it is now?
Well, I don't long for that day because it was very uncertain, and you waited on a Thursday afternoon or morning to see whether or not the Fed was changing its interest rates on a weekly basis. But I think the Fed is moving away a little bit from this certainty, from Draghi's whatever it takes, from basically alerting the market as to how high interest rates are going to go and what level they should be at. So, and I think that's a reflection of Stanley Fischer. He basically wants to move away from the certainty model. We'll see a little of that movement, but I'd like to at least to know a little bit about what the Fed is thinking in terms of new neutral interest rates, where they think the neutral interest rate should be relative to the Taylor rule, which they used prior to the recession, to the Great Recession in 2008 and 9.
Bill, let me ask you. This is the first time you and I have talked on air here since you made your move to Janus. You were a founder of PIMCO. Your name was synonymous with that firm. What's it like being someplace new after having spent your entire career elsewhere?
Well, it's certainly different. PIMCO had 2,500 people. Janus Newport, basically has 7 or 8, although Janus Denver, a much larger location and much larger corporation, has thousands of people too. And so it's a little bit different. There's more flexibility, basically, in what I'm doing, the unconstrained funds that are run on a separate account basis and the mutual funds. There's a lot more flexibility. There's the ability to move as opposed to not move so much as was the case in PIMCO. So, a little bit smaller, certainly, but a little bit more flexible, and I enjoy that.
Bill, a lot of people would have said, look, I don't need to do this. I got plenty of money. I've had plenty of success. Why keep going? Why get up and go to the office every day and do what you do at this point?
Well, part of it, my wife said she married me for better or worse, but not for lunch, and so lunchtime is spent in Newport Beach. But also, I wanted to show clients and to show the world to the extent that they're interested, that I can continue to produce a track record like I did at PIMCO. I won't have as much time. I won't have 5 to 10 to 15 years of leeway like I had at PIMCO in terms of proving that. But certainly for the next 2, 3, or 4 years, I'm a very competitive person, and I like to post numbers that are better than the market and better than the competition. So it's a combination of both of those.
Well, my congrats to you, Bill Gross. Great to see you. Hope to see you again soon.